futures contract allows traders to speculate on the price movement of commodities, currencies, stock market indices, and other assets. For example, consider the fluctuations in the price of a commodity like gold. A futures trader profits by anticipating the direction gold prices will move. To help illustrate why futures exist, what they do, and how traders profit from them, let's travel back in time to one of the earliest futures markets. In 18th century Japan, rice was a key part of the Japanese economy and functioned much like a currency. The shogun paid his samurai in rice for their support, who in turn would exchange the rice for goods and services. This worked fine when prices were stable. However, if the cost of rice suddenly dropped, say as a result of several good harvests, the purchasing power of rice would decrease significantly. This would lead to problems, samurai problems. Futures contracts help solve this. With a futures contract, samurai and rice merchants could negotiate a contract with a speculator that allowed them to buy or sell rice for a fixed price at a future date. This allowed samurai and rice merchants to lock in prices and pass the risk of price change on to the speculators. The same principle is used today in a wide variety of industries. Take coffee, for example. If the price of coffee beans goes down, it's good news for coffee shops, but bad news for coffee farmers. However, if the price of coffee beans goes up, the tables turn. With coffee bean futures, both coffee producers and coffee users are able to lock in prices ahead of time. Any potential profits or losses from price fluctuations in coffee are passed on to a futures trader. Now let's look at a futures contract from a trader's perspective. Assume you had one futures contract to purchase 100 ounces of gold at $1,000 an ounce in a 4 weeks' time. Now let's fast forward. The value of gold has jumped up $10 an ounce. Your investment has increased in value because the terms of your contract allows you to purchase gold at a price below market value. How much would this contract be worth? As we mentioned earlier, the contract specified that you will purchase 100 ounces of gold at $1,000 an ounce. Each ounce is currently valued at $1,010. Your contract allows you to purchase an ounce for $1,000 and is for 100 ounces. As a result, your investment would be worth around $1,000. So how much does a futures contract cost? Buying futures is different than purchasing a stock or an option. When you purchase a futures contract, you do not need to make a large payment up front. Instead, you are required to keep money in your account to fulfill the margin requirement. The margin requirement is only a small percentage of the value of the underlying asset. It's intended to be enough to cover the likely maximum one-day loss from changes in price to the value of an asset specified by the futures contract. At the end of each trading day, this money is used to settle any gains or losses made from your investment. For example, suppose a trade moved against you one trading day. At the end of that day, money would be removed from your account to cover the losses from your futures contract. If the loss was significant and enough money was removed that your account no longer had enough cash to cover the margin requirement, then you would be in a margin call situation. What happens during a margin call depends on your broker. You may be required to deposit additional funds to cover the margin, or your trade will be automatically sold. With a futures contract, a small investment can lead to big profits or big losses. This is because a futures contract is a leveraged investment. In investing, leverage is the ability to control a large amount of money with a small investment. Futures contracts are highly leveraged. Because of this, small changes in price of the underlying asset have a much larger impact on a futures contract. This is one reason why investing in futures is much riskier than other investments. So how can you use leverage to your advantage? Leverage can be a valuable ally when an investment is used as a hedge, a way to protect your portfolio. While a leveraged investment can be useful when used as a hedge, when it's your only position, you take on an extreme amount of risk that could easily wipe out your entire portfolio. Because prices can move quickly, futures trading is only for active investors. In fact, most futures contracts are bought and sold on the same day. Unlike the stock market, futures markets are open virtually all hours of the trading week, allowing traders to buy and sell futures contracts around the clock. If you're a more casual investor who only buys or sells a few stocks every couple of weeks, futures trading may not be for you.